We are working to improve the GOE's revenue, these are government-owned enterprises, revenue performance by reviewing the operational efficiencies and cost-to-income ratios and generally ensuring they operate in more fiscally responsible manner. Briefly about the global environment in which we are operating. The global economy is still characterized by uncertainty. However, the sluggish economic recovery is expected to pick up pace, while the global political terrain is expected to stabilize. Global GDP growth is projected at 3.9% in 2018, up from 3.8% in 2017. But emerging markets and developing economies are expected to lead with GDP growth of 4.9%. Advanced economies a bit slower at 2.5%. Despite the prospects of higher economic growth, inflation is expected to remain low in advanced economies. The US in particular is pulling back from quantitative easing with resultant increase in US interest rates, which could adversely affect capital flows to emerging and frontier markets. In emerging markets and developing economies, inflation is slowing down, and I'll speak more about that because in Nigeria it is slowing down, as the pass-through effects of earlier currency depreciations are waning. However, some non-economic factors could undermine medium-term prospects, which include geopolitical tensions, extreme weather events, terrorism, and security concerns. The challenges in the domestic environment, moving to the domestic environment, the challenges, of course, continue to include incidents of crude oil production shut-ins, some insurgency or restiveness, any possible severe weather conditions, particularly flooding of cities. But despite these challenges, we were able in 2017 to come out of the recession by sticking to the program of action stipulated in the Economic Recovery and Growth Plan, as well as the Strategic Implementation Plan for the 2016 budget. As at May, inflation was 11.61%. Our foreign reserves have been rising. As at 13th of June, it was actually $47 billion US. This is significantly higher than the reserves when we came in as a government, which was about $30 billion US. So it shows the trend, confidence in Nigeria, prudence in our management. And the exchange rate gap is also narrowing. Now, the approach to the 2018 budget. It is a budget of consolidation. Basically, we are consolidating on the achievements of 2016 and 2017 because those policies have set the economy back on a path of growth. And what works, you continue and you do even better. So we're following those plans set out in the Economic Recovery and Growth Plan. We plan to continue to spend more on ongoing infrastructure projects that have potentials for job creation and inclusive growth. We will continue to leverage private capital and counterpart funding for the delivery of infrastructure projects. And the reason is that even if we spend all our capital on infrastructure, it would still not be enough to get us where we want to be, where we need to be. And therefore, we have to partner with the private sector. As with the 2016 and 2017 budget, the 2018 budget has been prepared on the zero-based budget principles. The 2018-2020 medium-term fiscal framework and the budget proposal reflect many of the reforms and initiatives in the Economic Recovery and Growth Plan, which is our roadmap to economic recovery and more sustainable growth. Projects are linked to government policies and strategic objectives. Now, the key assumptions and macro framework of the 2018 budget. Now, all the key assumptions, except the oil price, as are set out in the Economic Recovery and Growth Plan. However, the oil price was adjusted upwards by the National Assembly to $51, which is, we believe, is achievable as an average price for this year, given where we are in the current, for the current price of crude oil. So we believe this increase by the National Assembly is achievable. Now, we've taken on board some key reform initiatives contained in the Economic Recovery and Growth Plan, such as deployment of new technology to improve revenue collection, upward review of some tariffs and tax rates where appropriate. Generally, we are not touching tax rates, generally, but in a few places where appropriate, we have done so. Stronger enforcement action against tax defaulters. Then we're seeking to improve the revenue performance of government-owned enterprises, as I said, by reviewing the operational efficiency and cost-to-income ratios, and generally ensuring that they operate in a more fiscally responsible manner. So the 2018 revenue projections reflect new funding mechanism for joint venture operations, allowing for cost recovery in lieu of previous cash call arrangements, additional oil-related revenues including royalty recovery, new marginal field licenses, early licensing renewals, and so on, review of the fiscal regime of oil production sharing contracts, restructuring of government's equity in joint venture oil assets, with proceeds to be reinvested in other assets. This will improve efficiencies in the operations of the joint ventures and position them for better revenue performance in the future. Increase in excise duty rates on alcohol and tobacco, which I had referred to earlier. Tax administration improvement initiatives. I think we're all familiar with the tax amnesty program. So the 2018 budget. Where is the money coming from to fund the budget? As you'll see from the table which has been set out, we expect a 41% increase in terms of oil revenues as between 2017 and 2018. Much of this comes from the higher price that we are expecting. You recall that I did indicate that we're using $51 as the reference price for oil. In addition to that, we are expecting customs revenue to go up significantly. Customs are doing very, very well, and we are expecting the revenues to go up significantly. However, companies' income tax and VAT, the reality of an economy coming out of recession is that sometimes there is a bit of a depression on companies' income tax, and we are taking that into account. So we have actually adjusted those downwards slightly. In the next slide indicates is still where the money is coming from, but indicates the percentage that we expect from the different sources. And as you can see, we're expecting 41.7% of revenues to come from oil, customs 4.5%, companies' income tax 9.2%, VAT 2.9%, recoveries 7.2%, tax amnesty 1.2%, and so on and so forth. I'd like to mention grants and donor funding. we now bring in grants and donor funding on two sides so that we can track and capture it. So we bring it in on the revenue side, we bring it in the same amount on the expenditure side so that we're able to track grants and donor funding. I'll take you now to expenditure proposals. Where is the money going? And as you can see, the total spending is more than 2017 budget by 23%. However, debt service is 21%, which is about the same as 2017 in terms of percentage. We have provided to additional increase of 7% for the provision to retire maturing bonds to local contractors. And that is because we want to try and clear a lot of those arrears. Recurrent non-debt spending is expected to rise by 17%. Some of it is the power sector recovery, in which we're allocating some money. I will speak a little bit more about that. Personnel, in which there's been we're providing for some recruitment, particularly in the security agencies. Now, capital expenditure. We've ensured that capital expenditure continues to maintain at least 30% of the overall expenditure. So it's gone up from 2.36 trillion naira in 2017 budget to 2.87 trillion naira in the 2018 budget. And as I said, capital spending is 31.5% of total FGN expenditure in 2018, because we made a commitment when we came in as a government from 2016 that we would always try and ensure that a minimum of 30% is devoted to capital expenditure. We have a deficit of 1.95 trillion, representing 1.74% of GDP, is within the threshold of the Fiscal Responsibility Act, and we intend to finance mainly by borrowing from domestic sources and from foreign sources. And a total of 306 billion is expected from privatization proceeds and 5 billion from the sale of other government assets. Now, the breakdown of the recurrent non-debt expenditure, as you can see, personnel costs still takes the lion's share, 60%, non-debt recurrent expenditure, 10% allocated to social investment program, which this government is committed to, 7% for overheads, 10% for pensions, 2% for the presidential amnesty program, 9% to other service-wide votes, and as I said, 5% for the provisions for the power sector recovery